with inversions as significant as 500 basis points at times. So we're looking for clues that we might be in that same kind of period, and what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side.
An economic cycle turning point is frequently indicated by consumer anxiety, and this time is no different. When the news is dominated by uncertainty and spending slows, it encourages revolutionary innovation. Market downturns have put prospective market leaders to the test in addition to contraction. Even though the recession caused many businesses to fail, the 2008 financial crisis saw the emergence of innovative technologies and businesses with a vision before the market crashed. Investors and consumers today face comparable difficulties. Despite the tighter budget, there is an increasing demand for quicker, less expensive, and more efficient solutions. The most daring discoveries are frequently the result of such fear and restraint. Cathie Wood, CEO of ARK Invest, sees parallels between the present and 2008. She remembers how her forward-thinking strategies outperformed in late 2008, prior to the recovery, thanks to early innovation and secular trend bets. According to her, genuine market leadership frequently appears during the most difficult periods rather than following a recovery. Technologies and business models that offer greater value at lower costs are gaining traction as Main Street grapples with inflation, job insecurity, and shifting expectations. Emerging innovators include fintech companies, AI-driven platforms, automation technologies, and clean energy solutions. As volatility drives out weaker players, visionary and flexible players are establishing long-term dominance. When it comes to the next generation of market champions, investors need to keep in mind who and when. For those who have the patience and foresight to recognize them early, the advantages could be revolutionary. According to Cathie Wood, the uncertainty of today plants the seeds of tomorrow's success.
Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold, and as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gov of GovCal is monitoring, and he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield. We did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5, but clearly the burden of proof is on us on that one. Finally, just the yield curve. I always like to go back to this and marvel that even though the monetary and fiscal authorities around the world threw everything they had at COVID, The yield curve could not get back to the steep levels it has seen during past fiscal and monetary stimulus moves. And I just think there is more of an underlying deflation message here, although at the same time you would expect to see high yield bonds being more jittery if this is indeed the case. So we're still wondering about this one. We know there's a message here. The downtrend is still in place. And maybe the message is, and just to end up on innovation, maybe we're going into a time just like the 50 years that ended in the late 20s when telephone, electricity, internal combustion engine were coming of age. And during that time, we were on the gold standard, so there was really no inflation problem. There were boom busts, but inflation was essentially zero when averaged out. But there was a deflationary tendency associated with these new technologies. So the yield curve was inverted. Even during the best of times, it was inverted most of the time, and at an average of 100 basis points. So that would be taking us down to where we were just a couple of years ago, 100 basis points on average, with inversions as significant as 500 basis points at times. So we're looking for clues that we might be in that same kind of period, and what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side.
Despite America's debt-to-GDP ratio reaching record highs, there is no post-war industrial boom to restore prosperity. In order to recover, today's polarized political environment relies on speculative assets, risky economic theories, and unsustainable tax cuts, unlike the 1990s, when fiscal restraint and bipartisan collaboration produced budget surpluses. Increasingly inconsistent inflation signals. The average taxpayer is exhausted, and core inflation persists in some sectors despite falling oil prices. Gold remains a hedge against economic instability and shows relative strength in the chaos, but commodities have fallen to early 2000s levels. Treasury yields have fallen below 4% due to investor apprehension and underlying demand, supported by $250 billion in stablecoins, a new and mostly unregulated dynamic in capitalism. Despite its long-term trend, Bitcoin, often called digital gold, is struggling to establish its dominance in the face of gold's recent surge. Additionally, Saudi Arabia's aggressive oil production is disrupting global energy markets and causing volatility. Conventional economic theories may no longer apply after the bond market's 40-year yield decline ended. Cathie Wood of ARK Invest sees this as a turning point, not a death spiral. She believes exponential innovation and tech-driven deflation could transform the economy. Debt models, traditional monetary policy, and historical precedents are no longer sufficient for the future, she believes. Instead, disruptive technologies that lower costs, scale productivity, and create new economic paradigms may write the next chapter. The real question is whether innovation can keep up with the global economy's structural imbalances and fiscal cliffs, not whether another financial crisis is coming. The stakes are higher than ever as the old game's rules collapse.
So here, I've seen these charts for years and years and years, but I didn't realize that we had hit from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading, in the tech and telecom bust, could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. more control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with Doge and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that truflation measure of inflation down even further. So we've often said we would not be surprised to see deflation. And you can see we have seen it at times in the past, certainly in COVID and in 2015, 16, when there was a lot of fear, a lot of volatility in the market, and a lot of fear about China imploding.
Economic uncertainty has historically fostered innovation, and the current situation is no exception. A new generation of tech disruptors emerged after the 2008 financial crisis, and tightening financial conditions and shaky consumer confidence may again lead to transformative change. Visionary leaders and disruptive technologies shine when fear overtakes and traditional systems fail. In 2008, ARK Invest CEO Cathie Wood noticed that her innovation-focused strategies outperformed before the market recovery, demonstrating that leadership often emerges during crisis. Today, we're seeing a similar turning point. Retail investors are adopting cryptocurrencies and stablecoins, which are changing global value and monetary systems. Cardano founder Charles Hoskinson predicts Bitcoin price targets of up to $250,000, citing geopolitical instability and a shift towards decentralized financial solutions. Although bold, these predictions reflect a larger trend. Traditional monetary policy is losing favor, and digital assets are filling the void. Once regulations are clear, tech giants like Apple and Amazon may institutionalize stablecoins. This could revolutionize mainstream financial systems by integrating blockchain-backed currencies into global commerce. This could validate digital currencies in everyday transactions and usher in a new era of faster, cheaper, and more accessible financial services. Due to rising U.S. debt, inflation, and political gridlock, traditional economic levers seem ineffective. As with previous downturns, new paradigms may be the answer. AI, blockchain, or fintech innovation may help navigate this uncharted territory. Right now, the next generation of industry titans may be quietly building solutions that could change wealth, value, and economic power. Will Bitcoin and decentralized finance replace gold as the best fiat collapse hedge? The debate is far from over, but innovation is rising from uncertainty again, and those who recognize its potential early may lead the future.